Hello, ladies and gentlemen, and welcome back. Well, it doesn't get bigger than this. That's right. This week is monetary policy statements galore for markets around the world. The Federal Reserve will come out and they'll let us know whether they're doing 75 basis points or 100. Many of you out there are expecting 100 basis points, and of course, the shock waves from the market could be quite big if that was to occur. But what happened on the Monday session was also very important. For anyone that was watching our live shows, which we do every single Monday before the market, usually an hour before, we thought that there was going to be a bull run. That is, the market was going to find some buyers. It kind of looks like a tweezer bottom. So is this going to have some further rallies into a key resistance, or is it just going to drop here and test the supports ahead of the FOMC? Let's take a look at everything to do with markets right now together. So much to discuss and some really interesting stuff on commodities as well. See you soon. So welcome back, everybody, to the Daily Show where we talk about stocks, commodities, and cryptos. If you like any of those markets, remember to subscribe. And of course, smash the like button if you find value in today's video. So did you know that 8 months from the last hike, we generally expect the first cut on average? This is data taken from 1955, and you'll notice here that on average, we expect around 8 months. Now, as of the last 24 hours in the market, the bonds market did something very, very interesting, and we'll take a look at that later on today's video as we go through the macro into, of course, the charts, the key levels you need to be looking at, and of course, the lead indicators. But in general, the expectation is that we rate hike. We sit somewhere around April of 2023 with a peaking that we'll look at soon, and we stay high for longer with a cut coming maybe the back end of 2023. This is an interesting stat and certainly something that we should be paying attention to because it will have dramatic ramifications through a whole bunch of markets. Which markets, you might say? Well, I believe commodities are one of these problems. We've just seen the percentage of commodity stocks go from above their 200-day moving average, 80%, to under their 200-day moving average. This switch has dramatic ramifications for the next 12 months, expectations for commodity indices throughout the world. And if you notice here, look at these stats. 1 week, 2 week, 1 month after these readings, 21% of the time, commodities were bullish after that period. That's not good. 36% of the time, 12 months later, they were bullish. That's not good either. That's actually very, very damning statistics here when we get these readings. And what it shows you is demand destruction. If your interest rate is increasing at an astronomical rate, which of course it is at the moment throughout most Western societies and all societies around the world, it's going to create demand destruction. We've been talking about this for a while, and it seems to be really hitting these commodity indices right now. Here's energy, 12 months later, a coin flip at best, generally negative. Here's the reading on materials, 12 months later, again, not very strong. So demand destruction's in full place. You can see that the statistics, the technicals, all of these things are really playing into this line of thought process, and especially the next 1 to 2 months could be very dicey here with these sectors. Now, if you're looking at seasonality, it would make sense. October and November can be some of the worst months for commodities, with December, January, February being a little bit better. So maybe we see a bit of weakness here, followed by a small amount of uptick, possibly a little bit later on. So what else about the market right now is interesting? Well, of course, we're in the worst month of the year. We've said this every single year since we started the channel, and so far so good. Septembers have always been horrible. And of course, the back end of September is the one a lot of people look to. Realistically, if we look at 1931 data to present, we tend to get weakness through the September into October months. And specifically, there's a lot of angling towards the last couple of days. Notice here, this is 1950 to 2021 S&P 500 returns. Those last 15 days tend to be very shaky. And of course, the last 10 days in particular, if you bought and then literally sold at the end of the last 10 days in September, there's a pretty damning stat here. And that doesn't look very positive towards a lot of people's accounts. Now, of course, this is just data and just seasonality, and it doesn't mean that it always is going to happen. But it's important to bring it along the line of, if you see, let's say, a shorting market during the time of September, often it can be more aggressive. And that's where you're using these stats. If the technicals come along with the data, it helps us a lot. And of course, we've been using this recently to really argue some of our cases. As you notice here, we've got over 200 years of data about bear markets and recoveries. Pause the video if you're interested. We bring this chart up quite regularly. We've also got the correlation matrices, which I haven't updated for a little while, but basically we're about here on the correlation with 1962. Obviously, we're super correlated with 2008 at this time. Basically, the most close correlation is 2008, and then we have the 73 correlation as well with the pullbacks coming in. In all cases, in these three, we had, of course, recessions, and what this led on was that we knew that there was at least going to be a good chance of a double dip. This is what helped us to really call that top back in August, to talk about the idea that the market was going to come back down for at least a double dip scenario. Will it be a bull case turnaround or a bear bust further lows? We don't know that quite yet, but of course, we hope to be following along with that over the next coming months. Midterm election years, market performance since 1962. Quick pause here if you're interested. Midterm election years are terrible. We've again brought this up quite a lot. I'd also say that it may be worthwhile penciling into your calendar the October 16th period of time, because that's when we'll see the CCP as well voting on a whole bunch of stuff to do with Chinese policies. That's going to be an important date. And remember, middle of October is often where we see the turn in the seasonality. So definitely the 16th of October, follow the channel if you're interested, because we'll be following that one. That's a story that not enough people are discussing. And I think it's going to have dramatic ramifications on these markets around the world, depending on what happens there. Let's begin our technical analysis and discuss the VIX. And to start off here with the VIX, or the volatility index, it's in the middle of nowhere. There's not much you can really think of here, but I did want to bring up the VIX. Just remember that generally speaking, we see bottoming of markets when we have a high VIX. That is, the VIX goes above a 40 zone handle. Now, when that does occur, we tend to see that fear or capitulation style trade coming in. This is not something, even with all of the problems in the market this year, that we've seen so far. So a lot of very smart people that I've been talking to, all they can say is, Tom, we haven't seen capitulation. We haven't seen it. We haven't seen it. Yeah, I get them. And of course, that's what a lot of people are looking for. A super high VIX that corresponds generally with a fearful market that could be going through its low process at that point. It's very rare for it to stop around here. Let's get into the yields. Could you believe the US 2-year is now almost at a 4 handle? Wow, this is pretty scary stuff, especially for people that have got a lot of debt. 3.949%. Yes, it's still low historically based on other times, but considering we went basically from 0 all the way up, this is a big deal. We're still around that point where you've gone through supports and resistances before, and you're kind of at like that kind of potential critical zone for 2 years. But I think where it gets more interesting is when we go out into the future. So when we look at something like April 2023, you'll notice 4.5% is the handle. But where things changed over the last 24 hours was here. Look at this. This is the big movement here from the September 2023. We're now going well higher, which is showing us that the market, the bonds market, believes inflation will be sticky. That is, that we will have to stay at a high rate, whatever that rate might be, for a very long period of time. And in fact, the cuts don't seem to be showing themselves until December of 2023 now, or 2023. I'll just bring that up. There we go. December 2023, 4.095%. So this is a huge deal, because what it really shows you is that, remember this, the only way inflation has ever been killed is for the inflation number to come underneath and stay underneath for some period the federal funds rate. So I've said this for a long time. I don't believe that the funds rate can get past 5 to 5.5%. And the main reason this is because, of course, when you're thinking about federal funds rates, if you push it too much further, there's so many dramatic, it's like the straw that breaks the camel's back. So you've just got to remember that we need inflation to come underneath, to kill it, to come underneath the federal funds rate and stay below there for a period of time before they can actually start to cut. This is just the facts to do with the Fed right now. And don't expect them to pivot until they kill inflation. The pivot story was pretty ridiculous. I never really believed it, but certainly that's going to be the big case here. Federal funds rate must be above the inflation rate for a period of time before they will even consider a cut, if they want to truly kill inflation. Let's talk about the market as a whole though, because dollar index just did something very interesting. We talked about this, the 110.25. We know that obviously everyone thinks cash is king at the moment. This is the safe haven of the world. It's really just US dollars and Swiss francs right now. Usually is Japanese yen, but Japanese yen is its own problem we'll talk about in the special video this week. And that will be one that we need to watch because of course we've got the monetary policy statements coming out there. But have a look at this. We've just hit into our demand zone. So over here, we've basically spiked into the demand and we've instantly found some buyers for the US dollar. If the market goes underneath this zone, I'll give you the price now, 109.28. If the price goes underneath that, then we do expect probably some form of rally and then that rally to be met by sell-off. If you're a buyer in the US stock market right now, you want the US dollar to go underneath this price pretty badly, really, because if that happens, it could show you money coming out of cash and potentially going into growth stocks ahead of the FOMC statement, etc., etc. This is now realistically very important for the market. A break of the 110.25 and a closure could signify new highs for the dollar index, and that's going to be very significant. So keep this chart on. US dollar, one to watch at this stage. Euro USD is the same. Of course, we've talked about the idea that buyers might have been committed around these levels in here. They were so far. We got a new high formed, but look at this. It instantly rejected against that. It basically came up and it instantly rejected against that. So it's gone straight back down, back underneath our resistance price here. If this ends up making a new low here, and of course the dollar index goes up, this could all be part of a very large trap towards the short side. So be very careful here on the euro. A good take profit would have been around this zone. And at this stage, it's all about that DXY. Continue to follow that. Gold is very similar. It's at critical. We've talked about this weekly level for a while. I'll just show everyone that hasn't been viewing the videos for a little while what we looked at. We looked at this low. Of course, all of these spike zones were previous buy levels. We liked that very much previously. Then, of course, we turned bearish up here. And we liked the idea of finding something bullish around here, but there just wasn't any great signals. What we now have is the last line of defense, 1660. We've hit it. We've found buyers at least immediately. Will they be able to hold it though? It's not that strong. It could just be very, very, very small kind of, I guess you would say, support. And then when we get underneath that, if it does get underneath, where's our next level? Is it all the way down here in 1580s or even 1460s? That's the problem for gold right now. It hates inflation. If inflation continues to get out of control, that's going to be a problem for gold. And of course, it's at that critical level right now in these markets. Oil is kind of similar. The problem with oil is, as we saw at the start of this video, the stats are just not lining up well for oil. Effectively, oil looks really weak in these markets at this stage. And over the medium term, which I've said for a long time now, I am still bearish on oil. And in fact, I still have targets that are set all the way down here in 65s. You might think, well, that's insane. A lot of it's got to do with demand destruction. So just remember that oil has been kind of shady, I would think, on some of the trade concepts. We've seen that resistance over here hold so far. We know there's supply around here that's a problem. And this smaller price range, look, the only way you'd be able to go even temporarily a little bit bullish, take that level, pull back a little bit, and then maybe move into this zone. At this stage, though, I don't think there's a super strong trade on oil. Of course, you can argue that if you'd like to in the comments down below. Let's move over to some stocks now. Tesla is right at those highs. Be very careful here, guys. We're coming into a massive event. Tesla is super bullish in comparison to the rest of the market. It's holding up very strongly. I would probably guess there's some option shenanigans going on here. Probably a lot of people trying to short it. It's getting squeezed partially against that. We're at a critical level. I have a kind of thought process here that we might take this high here or even take the 320 high and reject either of those very quickly. If that does happen, watch out for shorters to come directly into Tesla and push it back down, possibly even for these gaps. It's not acting the same as the rest of the market. And you could say, well, that's because Tesla's so strong, Tom. Possibly, but I will say this. It's right at that critical zone. I'm neither bullish nor bearish on it here. I'm just waiting to have the patience to react to the position should it show us an opportunity. And you'd want to see it really clear 320 and close above it for it to show you that it's ready to go to that next zone, which could be 360 plus on Tesla if that was to occur. Apple, something similar, nice little bounce here. Obviously a strong bounce on Apple. It did 2.5% for the day. Previous resistances, we spoke about this level. It did bounce off. I don't really think it's more about Apple. It's more about the market here. So we'll take a look at that in a second. Google, super critical zone. This 100 or just even underneath 100, I could see buyers all over this level at this stage. If it takes this level though and closes below, look at the gap that was left behind. Look at all of this market structure down here. You've got a really big drop potential here in the markets. And that's something that I think we can focus on here in these markets. Meta is something very similar. Now, a lot of people haven't been looking at Facebook, but I've got a level here that I want to discuss. 2020 lows. Yeah, that's right. Meta is in the sin bin right now. It is absolutely smashed. And I feel bad for people that have Facebook. Unfortunately, the metaverse, the NFTs, they're not working out here for this particular stock. Advertising revenue obviously dropping, etc., etc. But 2020 lows is a significant level. And I think that if you have alerts underneath that, there could be some action that happens around this level. So this will be one to watch, I believe, on the charts and set alerts for in the future. And of course, if you have strategies to trade around that, it might be a very interesting point. 2020 lows, significant. To move over to bonds, what are the bonds telling us? They had a pretty good 24 hours. Even my lead indicators on bonds were actually up across the board. So taking into account everything to do with interest rates and everything else, bonds were stronger than you would expect. We haven't seen the bonds make a new low yet. Here we have high yield corporate bond ETFs. Do they make a new low? If they do make a new low, that's probably front running the market. That is saying there's weakness, there's sickness in these markets. We need to focus on the bonds. Remember, it's been a series of lower highs so far, and that's helped us to determine that the stock market is coming down. Will the bonds find support here, or are they going to turn and go to new lows? Something we'll be following. Definitely subscribe to watch that. Let's move over to the DAX. DAX took a little bit of a new low and then bounced through. This is almost a carbon copy of the S&P 500. So we'll use the S&P 500 instead because the DAX isn't going to give us that much extra kind of help there. You'll notice that the NASDAQ, previous supports that were found or previous demand levels that were found back in May and June were again respected through the last 24 hours. We'll go down to the 5-minute chart here just to have a look. We obviously covered this in our live session, and we talked about the idea of it taking this resistance zone, this supply up here of 11,880, and basically then rejecting through the middle of the session with a pullback afterwards. That's exactly what happened. It was actually quite a good trade. And certainly if you're paying attention and following the concepts that we were talking about on the live stream, it's exactly the structure that happened there. Now, what's next though for this particular index or these particular indices across the US? Well, the problem is that we have a major issue in a few different locations. From standard support resistance, you'd say we're at resistance. 12,000, psychological level, previous lows. I could see sellers trying to sell here. But will the market drive higher to a critical zone? Usually the markets like to, ahead of the FOMC, be either at a critical resistance or a critical support in terms of where they're at, because big news events allow the market to have an excuse to push to the next level of equilibrium. So will we actually get back up to 12,200? I'm certainly looking at this key zone here as being that potential short zone for the week for a lot of people out there when they're looking at these markets. This, I can see why, but at the same time, where's your stop loss going to be? Is it going to be above here? You know, how have you actually allocated a short in this location? Is it an option? What is it? Because it's right around that key level, sure, but it's not at an extreme level yet. And that's something I think we'll be looking at. S&P 500 filled the gap. Obviously, it bounced. These are some of the levels we've talked about in the future. During a double dip scenario, I'd like to see the market at least get down to this 3750, if not a little bit lower. Then possibly it bounces, or of course it makes its decision to go low, low, low all the way back down. And for a lot of people, at least the big first support here is going to be the 200 moving average. Just remember, if you haven't followed the channel for a while, the 200 weekly is a well-respected moving average. Go back through the history. 2008, we get a bounce. Resistance formed in 2010. 2012, we get a bounce. 2016 lows, we get a bounce during the double dip. And of course, 2018, we bounce off that level. The only real time it hasn't respected it has been the pandemic, but let's face it, the market was in meltdown during that time. It wasn't very technical, it was absolutely freaking out. And maybe one day I'll show everybody here on the channel why that was so terrifying truly from a bond perspective, because it was pretty scary stuff. Let's now have a look at the smaller timeframes here. It looks kind of like a tweezer on the futures market. You can see that low getting taken. This is how we figured out that zone, 38.30, big level. We did talk about the bullishness. A lot of you were unfortunately bearish. Hopefully no one got too burnt yesterday when we did the poll on the live stream, and we took that level that we discussed, the 38.80. We got above it, we pulled back, and we found some buyers. And then I think it was a pretty decent trading day. Ultimately, taking the low was a pretty big thing. It did definitely change the kind of schematics and the concepts around this market, and it pushed that high. For resistance levels this week, the critical zone is 39.60. Again, I could see why people are trying to short here. It's like a support becomes resistance level, but I could really see this market trying to push into these zones. It's possible it could short here, but you've got to just have, again, the patience to react. Sometimes you're going to miss it. And if you miss a short here, and let's say the market does come through and go all the way down to a 37.80 or a 37.50, guess what? Who cares? There's another opportunity potentially there towards the buy if it does happen, or even further selling. Never feel FOMO, guys. Always another opportunity. Speaking of large opportunities, what about Bitcoin? It practices the massive manipulation of getting to that new low, but not the lowest low, and then finding those buyers coming back in. I want to just quickly talk about my longer term prospects for Bitcoin. Now, I actually feel like the market is probably going to go lower, and the Bitcoin will probably go lower with it. In fact, it's seasonally, it's crypto winter, it's all these things. And you'll notice I've written 150 days here, and I put this on our Twitter. Follow at FX Evolution if you're interested on Twitter handle. And effectively, I believe that we could be going much lower on Bitcoin. In fact, my expectation, I've had this for a while, is to go between 9,000 and 12,000 on Bitcoin over the next 150 days. And you might say, Tom, that's stupid. 150 days, are you out of your mind? Hey, it's more of an investment concept. You've got to believe in the idea that most other cycles, we've seen that capitulation dropping of Bitcoin, and then we saw it kind of basing off. This could be the low, it's possible. But my expectation is still to get these other lowers in, the points here before the whole boom of 2020 to 2021. I want to go back down to these levels. And figuratively, it should happen before, let's say, the 15th, 16th of February 2023. We'll find out whether it does. We'll continue to follow crypto along those lines. If you haven't already, come and follow us at FX Evolution on Twitter. And of course, remember the calendar this week. It's all happening. We've got the FOMC statement, economic projections coming out, expectations, 75 basis points going to 3.25%. But remember, it's going to go to 4.5% if the bond market is correct. Then we've got the Bank of Japan press conference coming out Thursday, New York time, tentative, but usually it's around the same period. I'll talk about that in the next video. We've got monetary policy statements coming out for the CHF, for the Great British Pound, the Euro. There's so much data. It's just a huge monetary policy week. If you're interested in finding out more about what we do here at FX Evolution, we've just launched our Scalping Advanced Masterclass. You can definitely look at the sale that we've got on all our courses at the moment for the Red September sale. And yeah, I'd highly recommend, if you're interested, check out some of those. If you're interested in purchasing it, of course, jumping on board. And we'd love to see you in our private community and everything else. As always, guys, thanks so much for the support. And of course, smash the like button and subscribe if you enjoyed our content. We'll see you in the next one. Bye for now.